This particular deal is going to make over $750,000 for the general partner. What we just did is the magic trick that a lot of syndicators like to do to make their deals look amazing. Whoa. Let's invest in that deal, Hait. Hey guys, I'm Matt Faircloth from the DeRosa Group, and I'm standing in front of a 30-unit apartment building in Trenton, New Jersey. We are able to pull off deals like this and larger deals because we've got a great analyzing, underwriting process for our deals. If you want to do multifamily deals too, the key is doing good underwriting. We're going to hang out with the DeRosa underwriting team and learn about what DeRosa does to analyze good deals and bad deals. We'll give you guys a free copy of DeRosa's underwriting software that we use. We want you guys to be able to do stuff like this as well. So watch this video and let's get into it. This particular deal is going to make over $750,000 for the general partner in their profit, while they also return 20-30% to their investors. Wow, you win and they win too. So if you guys want to make that kind of money by providing great real estate opportunities to your investors, let's hop in and talk underwriting. What better way to learn how to do this than to get inside the mind of the underwriter for DeRosa, the Hait Patel. Let's bring him on the show. Hait, how are you today, buddy?
Good. How are you today, Matt?
I'm doing good, man. Hey, can you introduce yourself to our audience?
Yeah, so I've been with DeRosa now for almost 3 years. And before that, I was doing hospitality, limited service hotels, your country inns, your Hamptons, your Fairfields. So, underwriting deals on that side and then transitioning over to the multifamily side. And now we're adding new product types such as new developments, along with a little bit of retail component and triple nets.
You can't just jump in and start analyzing 30, 40 unit apartment building deals. You got to know what matters and what doesn't. Hey, let's talk through the key metrics of underwriting deals and maybe talk through some key terminology. And to do that, I'd like for you to share the tool that we use here at DeRosa. So let's share your screen and look at some real numbers. Let's pop your spreadsheet up here and jump into some of the key terminology that underwriters need to know.
At DeRosa, we have developed our own tool. We have actually two tools built into one. So we have one that is a 15-minute analyzer, and then we have our full-blown underwriting tool. We do have a list of glossary here, which we put together. This glossary provides you an in-depth definition along with what a lender is going to look at versus what a mortgage broker is going to look at versus what an insurance broker is going to look at. Each plays a different part in a transaction, right? The insurance broker is worried about what's the square footage, how old is the building, what's the electricals on this. The mortgage brokers are more worried about the DSCR, what the debt yield is. If we can cover, they're also going to be focused on ratios of what is the ratio of your NOI compared to your gross income. We have it broken down here pretty well, and we'll go along and just show from a very beginner, if you're very new to underwriting, what a T12 or what a P&L and a pro forma might look like for you.
You and I talk a lot in lingo in the real estate world, and I want to throw out to the listeners that you got to learn the lingo, number one, when you talk to the broker, because they think you know what you're talking about, right? If you use the lingo that they use. But let's explain to you what these things are, right? This is a T12, right? And hey, what is a T12 and why does it matter?
Yeah, so in the multifamily world, a T12 is your trailing 12 performance. So let's say we are looking at an asset to purchase, we'll request with the broker to send us over a trailing 12. That is a P&L that shows you for the last 12 months, let's say from January to December, what the performance of the asset was. It'll have a breakdown for each month, what the overall revenues were for that month and what the overall expense were for that month. However, for us, we also do an analysis based on a trailing 6 and a trailing 3. So that means a trailing 3-month analysis, a trailing 6-month analysis, along with the trailing 12-month analysis. Why this is important, as we can show you in this case particularly, when we look at our overall income, when you combine the rents along with your other pet fees, your maintenance fees, your media package, whatever it might be, you can see that on a trailing 12 or on a 12-month basis, our income is $1,179,000, but on a trailing 3 basis, our income is $1.3 million. So this is a very stark difference, and this is what we want to see: is that the rents and the income is growing over a 9-month period. So in this case, it's very helpful, but this might not always be the scenario. We have seen plenty of properties about Matt where they've been declining revenues on a trailing 3 compared to a trailing 12.
It sounds like, Hait, what you're saying is that a T12 enables the underwriter to see the trend. Because somebody could try and sell me a 20-unit apartment building and say, oh yeah, it's rented for $20,000 a month. Great, but you might look and see, if you looked at a T12, that it was rented for $30,000 a month a few months ago, and now they're down to 20, and they're headed down to 15,000 in that. So you would see a problem versus something static and somebody just telling you how much they're collecting at a given time. The second thing that I hear a lot of people that we at DeRosa, and that all people that are really looking seriously at multifamily know to ask for, is a rent roll. Could you show us a rent roll real quick, Hait, and explain why that's important as well?
Yeah, so this rent roll, it showcases to us, number one, the number of units that are at the property. Secondly, what the unit mix is going to be, but this might not always be the case depending on who's sending you the rent roll. We have had some rent rolls that were handwritten where we did not even get this information.
Yeah, we that might be napkin rent rolls. I've had verbal rent rolls just given to me. That guy moved in about 2 years ago, and but it does happen. But you still have to compile the data, right?
Yeah, and then we break it down internally ourselves once we have enough data to classify each unit, if it's been renovated, if it's a classic, or it's a partial renovation. This gives us an idea on the back end for a CapEx budget and what that might look like for each specific unit type.
CapEx budget, just to help folks out here, yes. What that means is if there's a classic unit, that's a really nice way of saying an unrenovated, maybe a unit that needs a facelift unit, right? And for example, let's go through a real life example here, Hait. Let's say you've got a classic unit that's rented at, show me a disparity here in classic versus market rents, if you can, just so we can explain it to the listeners.
Yeah, so this one right here, we are at $899, yep, which seems to be the average for the one bedrooms at the current rents they're at. So effective rents means current rents. That's what the apartment is currently getting. That's what the resident is paying on a rent basis.
Yep.
Market rent is going to be what you or what the current management company assumes this unit should be performing at. So as we can see, just between the first two units right here, the first one is getting the $999 rents. That is the market rent. However, the second two units, which are newer leases, as you can see, this one is 1024, this one's older, but they're not getting the $999 performance at the moment. And then you have this one, which is going beyond the $999 performance at $1199.
Yeah.
So there's always going to be discrepancy when you're analyzing these, especially on a bigger scale. As anything more than 100 units, you will see a lot of discrepancy between market rents versus what the current rents are, because you're going to have some leases that are month to month, so you have to figure that out. You're going to have some leases that might be furnished units, and then you have just units that are outperforming the market.
Yeah, and you might also find that as you study the market, as you look at other apartment communities around the vicinity of the property you're looking at, that a one bedroom around that same square footage with, let's say, for example, Hait, stainless steel appliances, maybe new or painted cabinets, new flooring, a nicely renovated unit that could cost you between $3,000 to $8,000 per unit to renovate. You might be able to command $1,200, right? And doesn't mean you have to start throwing people out of the apartment community. It just might mean that as tenants move out, the market may be willing to absorb higher quality units if you're willing to create them at this property, which could mean that, so if I can get $300 more in rent through investing $8,000, hey, that's quick numbers, right? $300 a month times 12 months, that's $3,600 a year, folks, for every unit that I'm able to renovate, right? For an investment of even $8,000, that's a really great return on investment. Times over if you've got a larger apartment community. So that's the value add game, and that's what you can see here when you look at a rent roll, right?
We are done our rent roll, we'll build out our own unit matrix. So like this particular unit has 12 one bedrooms at classic units. That means, and the other matrix that are important within the rent roll is going to be the square footage.
Yeah.
Very primitive, because square footage matters a lot in real estate, especially on the development side, as well as opportunity to purchase. Like we'll look at pricing per square foot, what our overall building square footage is, and what we're paying on a per square foot basis at the end of the day. Along with that, what you're achieving from a square foot perspective is $999 on a 724 square foot. That's pretty good rents, depending on the market. And we'll go more into the details of that. But yeah, in terms of the rent roll analysis, square footage, how many units, effective rents and market rents, Along with that, you really want to get the data on when your leases started and when they're expiring. This helps you, along with the property management team, make a plan on how you're going to plan your renovations, how you're going to plan a lease up, and how you're going to be able to creatively make a business plan around that.
Hey, the next thing that really matters in analyzing deals, and this is all great information, what I think some key metrics that determine your debt financing and even all the way up to what you can even offer on a property are three factors. And they are the NOI, the cap rate, and the DSCR, the debt service coverage ratio. Can we go through these one by one and maybe even show what happens when these things move a bit in an underwriting analysis on a deal?
This property was brought to us at a 5.2 million price, which is pretty attractive in today's market. It's about 65,000 on a price per unit. It is an older asset. It was in 1970s. Let me just make sure and confirm with you. 1975 asset. So it is on the older side. It's a vintage.
Which is 65 a door is about right. People still need to live
Yeah.
in properties built in the 60s and 70s. We need that housing. There's nothing wrong with it. Just understand that we analyze housing like that, guys. It's going to need a little bit more work. So make sure that you've got a heavy maintenance budget for older vintage properties. But for that, you can buy them for well below replacement cost. You can't build something for 65,000 a unit, I promise. So if you can buy it for that, that's already a good deal. So hey, talk us through those core metrics that I mentioned and how they play here.
Yeah, so what we're going to do is we're just going to look at the deal very quick and see that our before renovation rents on average is 94,000 on a monthly basis. And after we renovate the property and put in the love that it needs, we're looking to get rents of 104,000. So we can see the NOI based on this 10-year projected, based on the debt service and everything. What is net operating income? It's your overall revenues minus your overall expense. So your net operating income in this specific scenario, we have 462,000. And by the time we have our value add plan built in and the property goes through a full cycle of 10 years, we're looking to end this at 552,000. It's a pretty good nice gain over a 10-year term. And how this affects your pricing is that when you're selling this asset, particularly in, let's say, in today's environment where this kind of asset trades at a 6 cap rate. So let's go more into the cap rate. A cap rate is what, if you were to buy this building 100% in cash, you would earn 6% cash on cash return. That's how you can define a cap rate. For multifamily investors, cap rate matters because it is very correlated with interest rates. So in today's environment, when interest rates are higher, particularly on 1970s and 60s vintage assets, we're seeing cap rates in anywhere from 6 to 8% given market and location. So for us, if we're buying this particular project at a 6 cap and we're looking to exit at a 6 cap, we are going to gain about 100,000 of net operating income, and that is going to have a very great correlation to your exit cap when you discount it at a 6%.
Let me just boil it down, guys. So NOI is the amount of money you make in top line rent, right? Coming into the property, all your income minus all your expenses. So your expenses could be your real estate taxes, your insurance, all your debt payments. This calculator we have here that you guys can grab for free, by the way, has all that calculated in that. And then there's a bottom line NOI that you would make. And as Hait said, if you own the property free and clear, that's how much you would make each year in total profit. You got to view these properties as if they're just a business. Like this is a business that hopefully spits out cash. And this is how much money that business makes. If you choose to finance the purchase of that business, then you can using typical mortgage factors, and then your cash flow that you make, your NOI, part of that gets applied to paying your debt. And we'll get to a DSCR calc in just a second here.
Yeah, and this is our 15-minute analyzer where we, as DeRosa, for me, okay, I'm getting an 11.95% IRR and a 6.2% cash on cash based on just 15 minutes of analyze. So this means I'll go ahead and spend more time on this deal.
Show me real quick, Hait, what happens to that bottom line, those bottom line numbers, if you were to be able to increase rents by, I don't know, $50 more, by adding a washer dryer connection to the units, doing some further value that the tenants may desire to have. Maybe there's just the market changes a little bit and you're able to just drive up rents a little bit further. So let's say $50 more is what you're able to command per month on the units. In a good underwriting software like this one, you could probably apply that pretty quickly. So show us what that does to the bottom line in profitability on this deal over time.
Yeah, and there's multiple ways we can increase this. We can increase the percentage, but for the simplicity's sake, I'll just, as we remember looking at the rent roll, some of these units were already getting that 1,199 rent. So it's not unrealistic. Like we're underwriting 1105 on a conservative basis on our very first try. But let's say, Matt, if we get that 1119 across the board on all one bed units, right? On renovated, we can see the effect of that just on those two alone. You're increasing $1,000. And then our renovated 2 bedrooms, we can push those up to 1299, 1399, 1399, and 3 bedrooms they're already pushing higher on the market rent. So if you want, we can leave that for now and see what the overall effect is, just increasing the 1 bedroom
Let's
and
leave
two
it and do a
bedrooms.
quick look. And this is what's great, guys, about an underwriting tool is you can just literally wait a little bit and say, okay, what would happen if? Look at the return. Whoa, I want to invest in that deal. Hey, that's a great deal. I love your red turn to a green as well, right? 9.4% cash on cash, guys. Any investor out there, you could get excited about a 9.4% cash on cash. In today's market, that's more than double what they're going to make in a savings account. And 25% IRR. That means for every dollar they put in, annualized, they make $1.25 annually when you sell that property after year 10. The increase in NOI went quite a bit up there too. So that's what just changing a little bit of rents does to NOI. Now, hey, we talked about cap rate as well. Does our software here analyze? Does it allow you to change the exit cap rate?
Yeah. So on this particular exit, I think I have it at 10 years. Yeah. So we have our exit at 10 years and 10 years, and we're assuming a 7.5 cap rate assumption.
Now,
so our value on the building, go ahead.
Yeah. No, keep going. I'm sorry.
Yeah. So our value on the building when we bought it was 5.25 million, and we needed equity of about we needed about 1.5 million of equity to make this transaction happen, and that includes your capex budget. That includes all the expense and reserves that you built into this calculation, right? At exit, we're looking to get 7 million out of this deal. So on an equity multiple, your net proceeds at sale are $2.6 million, and you were into this deal at 1.5 million.
So you're more than double.
This is a year 3 exit. Yeah.
Okay.
This is a year 3 exit.
Talking about cap rate, on the exit cap rate, what are some things, Hait, that if we were to adjust the cap rate, what would give an underwriter like yourself or maybe someone watching here the right to change that cap rate? Like, why would they, Matt, maybe I should make it an 8, or maybe I should make it a 6 or 6.5. Cap rates are not static. They do change. So what are things that cause cap rates to fluctuate and that would inspire an underwriter to maybe move that up or down?
Yeah, so let's say in today's market right now, where the Fed has announced that you have 2 rate cuts that are coming due, and we are not looking to sell this asset for another 3 years. So for us, we could potentially push the cap rate down. However, the constraint I have particularly is this price per unit number. Because of the vintage being 1975, and because of the market that we know it's currently in, the price per unit is also going to be very imperative. Even if you sell it at 7.5 cap rate, there's the buyer pool for this asset is small. It's a smaller asset in itself, and the buyer pool is also smaller because not a lot of people are looking at 70s vintage anymore, especially from a syndication perspective.
Sure. This asset just got 10 years older as well. So
yeah,
it's
exactly.
if you wait that long. So let's say that the affinity for this type of asset, maybe the market that it's in, wherever it is, becomes less attractive. Because the way I view it sometimes, Hait, when I think about cap rate is a risk factor that the investor is willing to take, given where debt is. They might be willing to, if risk is a little bit higher on the asset, so it could be a little bit older vintage, could be in a market that's a little more dicey, maybe not Austin, maybe more Detroit versus Austin, that kind of thing. Maybe they're going to shift cap rates higher. So let's say for this deal, they are more comfortable at an exit cap rate of 8.5%. Let's throw that in there and see what it does. Okay, now scroll up and show me what that just did to the IRR. Oh, okay, big change. Guys, got cut in half. Cash on cash stayed the same, right? Because you're still making cash flow while you hold it, but you're not selling it for as high of a number when you sell. So all that affected, my cash on cash still stayed at 9.4, but my IRR went to 11.9. Now, hey, let's say that there is a higher affinity for one reason or another for older vintage assets like this, or let's just say rates go back down to big party time to 2-3% or something like that. In the market that it's in, they get a new NFL team, and Amazon decides to open up a big corporate office there, or whatever happens that makes the market amazing. What if that cap rate goes from 7.5 down to 6.5? Now, guys, understand, the lower cap rate goes, the more a property is going to sell for, right? So let's take a look to see what that just did to the returns on that deal. Whoa. Let's invest in that deal, Hait. Let's cross our fingers and hope. Now, side note, Hait, what we just did is the magic trick that a lot of syndicators like to do to make their deals look amazing. So if anybody's watching this, learning maybe how to underwrite deals themselves, but also perhaps how to be a good passive investor, that magic trick of dropping your cap rate on the out sale is the way a lot of syndicators make their deals look good. So I'm talking to you guys, pay attention to the exit cap rate when you're looking at deals, because that's a good way to make poof, magic fairy dust, make your deal look amazing when maybe it ain't that amazing. Okay, now let's hop back in. Yeah.
And I wanted to point back, like when we did the 8.5 and now or 8.5 exit cap, our cash on cash is 9.4 and our IRR is 11.9, which to me as an investor, it's quite attractive because most of my IRR now is coming from cash on cash.
Yeah.
It's not being pushed by the exit anymore.
Yeah.
We're 9.5% of the IRR is coming from cash on cash.
If I'm an operator, like then we're going off just tangentially a little bit, but I love going tangent. I can't help myself. I see this deal, I'm not selling. I'm just going to hold it. I just make 9.4. My investors are going to love it. They're making 9.4. By the way, that's investor cash on cash return at 9.4. The operator makes money on top of that, right?
Yes. This is a simple calculation on a 15-minute deal basis.
Yeah.
So this gives me a heads up. All right, I can go ahead and spend more time and go into the full analysis mode where we can showcase what goes more in depth.
That's what goes on in Matt's brain. If I'm making that much money in cash on cash return, why sell to make another 2%? Just hold it and wait for cap rates to change. Maybe keep it on amortizing debt and keep paying it off over time and everything like that. But hey, I digress. Let's get back in. Hey, one other factor, DSCR, debt service coverage ratio. Can you quickly highlight what that is, why it matters for deals like this, or for any multifamily deal for that matter?
Yeah, so DSCR is your ability for a lender or a mortgage broker that you have. It showcases your ability that the property can pay them their debt. Most lenders, or not most, I would say, in a stabilized loan, they're going to target a 1.25 DSCR. And on a bridge debt, that DSCR can drop down to 0.75, 0.85, depending on the deal and what the worthiness of the deal is going on a future three-year projection maybe. So like for us particularly, if you're looking at a bigger deal where it's, let's say, for example, 300 unit deal, similar vintage, where it's going to take almost 2.5 years to renovate, we're going to throw on what is known as a bridge debt on for 2 years. And then we'll go into a Freddie Fannie agency debt on the back end in year 3. And then the 1.25 DSCR will apply to us. In this particular deal, we're looking at doing a regional debt in the first place. A regional debt means your local credit unions, your regional banks that are specific to the region, or any local connections you have. So we're going to use a regional debt in this particular case, where we were able to push the DSCR up to 1.83 in the first 2 years. And after we refinance, and this is based on IO, interest only, the DSCR calculation is, but even without the DSCR, one second.
So just like that, through a few clicks of a button, you calculated to where the debt is getting paid off each month.
Yeah, so once a debt gets paid off, because way the DSCR is calculated on the Freddie Fannie side is going to be based on without any IO. For us, we're still going to be very healthy at the 2.12 DSCR after we throw on agency debt, because even if we do a fully amortizing debt, we're going to be well above that 1.25 DSCR.
I'm going to put it in plain English, guys. What a 2.12 debt service coverage ratio means. It means that with the money that you make, you bring in rent, you pay all your bills, so to speak, for the property, and you got to pay your debt. This property at a 2.1 debt service coverage ratio can pay its mortgage twice every month. right? It can pay or the mortgage payment that it's whatever the mortgage payment is, 10,000 a month, 20,000 a month, whatever it is. That's how much you could be making in cash flow, right? Anything above a 1.0 means that the property can pay its debt. Banks typically look, as you said, hey, for somewhere around a 1.2 to 1.3 debt service coverage ratio. I can tell you firsthand as a real estate investor, that's kind of lean for you, because that means that for every dollar you pay your bank, you get to keep 30 cents. I'd rather keep a little bit more than that for me and my investors. And a 1.2, 1.3 debt service coverage ratio should not be your goal. That's just what your bank is going to say yes or no to. You should try and strive to be in the high ones or even in the twos. That's phenomenal. That means you're just keeping that much more of the money you're making from the property in cash flow, which is what it really all boils down to, the cash flow that you make. It's not how much money you make in these properties, it's how much you get to keep.
No, 100% agree with that. The better we can perform on the assets, especially in the long term, where you can see when we have a fully amortizing debt, we are still getting 1.8, 1.9, and by year 10, almost 2%. So any dollar that comes in, a dollar goes to the lender, but then dollar also goes back to the investors as well in that case.
Love it. And one last quick, we don't have to unpack it too much here, guys, but look at that breaking even occupancy on a larger asset like this. With that gives you and your investors that peace of mind, knowing that, okay, this property could drop down to 75% occupancy, which, I mean, that happens overnight on a 4-family, on a quadruplex. One tenant moves out and you're at 75% occupancy. But on a larger asset like this, you'd have to have a couple of move outs in a row, or have the property really start to get a little bit run down to have people no longer willing to live there, and you drop down to 75%. So that should give you peace of mind to know that to be able to pay your debt and all your bills, you could drop all the way down to 75%. Anything you make above, if the property's operating above 75% occupancy, it means you're profitable. That's great. And that should give you that peace of mind to know that this is a good asset, and it can have that level of fluctuation and go up and down in the market. And look, the longer you hold it, it gets down to the 60s, then back up into the 70s once the debt starts amortizing. So this is just a really great way to really take the temperature on a deal that you're looking at. Hey, I'd like to transition now to more macroscopic, to you as an underwriter. A deal like this lands on your plate. I think we've covered a few things here, but I want to make sure I really got it from you. Yeah. What are the first couple things that you look at when a deal lands for you to get to a go, no go on real estate?
Yeah, so when we get a deal, particularly ourselves, and how I start my analysis is first looking at the purchase price, making sure when we talk to the broker or the owner, whoever it might be directly, it's okay, do they have room to move or not? The first and foremost question, because if they're very firm at this deal, they started off at 525 and it's very attractive pricing. However, we have seen deals where it's a similar exact case as this, but the asking price might be like 80,000 a door.
Yeah. And
at that point, I already know it does not work, but I don't know, the piece of dirt might be worth more, maybe, or maybe the market is, like you mentioned, maybe there's something big coming into the market and that's what they're pricing it for. So
you make sure the pricing is realistic.
Yeah, the pricing has to be realistic for today's terms. We also are in contact with our mortgage brokers on a weekly basis, right? So we also get all of their information on what they're seeing, what their kind of loan we'll be able to get on such an asset, and what the interest rate on it, what the loan to value on that is going to be. Having those conversations on a daily basis helps us underwrite this asset. Particularly when I'm looking at it, I'm looking at a price per door. I'm looking at the cap rate. Like on this particular deal, we're at a 5.61 cap rate going in. However, you can see on a trailing 3 basis where we saw the revenue increase to 1.3 million, we're looking at a 7.2 cap rate going in. There's some attractiveness to it to start off the deal.
That's probably, I got to tell you, that is probably one of the biggest secrets that I haven't heard that discussed enough in the underwriting community, is to monitor the trend of the property by looking at the trailing 12 compared to the trailing 6 compared to the trailing 3. Where is this property going? This property is going in the right direction, and that's maybe something that makes it more promising to Hait. And that's why a good underwriting tool is important to have, because you can look in it and see where things are heading. If you guys are underwriting a deal that it takes you 4 or 5 hours to analyze, and it gets to a no, I'm not saying you wasted that much time, but wouldn't it have been that much better if using something like this, you could have gotten to a no in 15 minutes? You got yourself over 4 hours back. And let's bring this home, guys. We love making money for our investors, Hate, but this is also not a hobby. We need to make money too to do what we do. Can you show us real quick how underwriters consider what the general partnership profit's going to make on a deal, and maybe show us what the GP cash flows in fees and cash flow splits would look like on a deal like this?
Yeah, so in a deal like this, the general partnership, we're raising almost, let's just round up to $3 million of equity. Over a 10-year period, our investors are going to make $3.3 million, and the GP cash flow is going to be around $708,000. This is based on a 7% pref given to our investors. That means that anyone that invests into this $3 million pool, they get a 7% cash on that first. So meaning they get a 7% cash on cash. And after that, there's an 80% split, or 80 and 20% split. So once an investor gets 7% of their money, then the GP side will get 20% after that. And after we hit a 14% hurdle, we go down to a 60-40. So once the investor, on all of their money they're investing, the $3 million, gets a $14 million return, after that, any dollar that comes in will be 60% theirs and 40% on the sponsorship side for performing at an expecting level.
I'm so glad you explained pref, because that term gets thrown around like, what's your pref? What's preferred return? Again, we all got to learn somewhere. So that's a great explanation of preferred return. And I'm glad that it's here and you're facing this sheet as well, so people can decide, well, do I want to pay an 8 pref? Or do I want to see if my investors can accept a 6 pref? But 7's kind of a good median for the market too. This is a great analysis of how we can make investors money. We also make some money too. And that's what underwriting is all about, and finding a good equation for GP profit, LP profit, and a path to success for real estate acquisitions. Guys, one last time, if you guys want to grab a copy of DeRosa's underwriting tool, click the link below. We've got a link here in the description, and you guys can grab a copy of our 15-minute go, no go dashboard, so you too can underwrite deals and maybe find something like this. Hait, Patel, phenomenal conversation today. Really enjoyed having you on our YouTube channel to talk deep dive analysis of real estate.